Hey fellow dividend and value investors, welcome back to another video on this channel. This time I would like to discuss the freshly announced Johnson & Johnson spin-off with you. They announced the news on Friday and I think it's fair to say that it surprised the whole investment community and especially to us as dividend investors. So the question then of course remains is, what does this mean for us? And that's exactly what I will discuss today based on the available information at hand. So don't worry, I got you covered. Just have your coffee or tea ready and let's get started. Hey guys, just 3 weeks ago I made a video about Johnson & Johnson because I just wanted to know what I own. I didn't look into the company for 4 years or something like that, so I was really wondering what is this company doing nowadays? What is really driving their growth? And what surprised me? It is really a biotech company nowadays because the consumer business at the time, based on my analysis, had hardly any growth and Pharma was really pulling it all forward. So in a nutshell, this spin-off to me is not a surprise from that point of view. So it is just a reiteration again of what we know. Just really understand what you own in your portfolio, and these kind of news, of course, come as a surprise, but shouldn't be a surprise based on your understanding of the business. Hey, let's get into the story of today. Let's talk about the spin-off. So look, Johnson & Johnson is probably the dividend king that we all know of as dividend growth investors. It has a track record of 59 years of dividend growth, and since 1973 it has a compounded annual growth rate of 12.8% when it comes to dividend growth. At the same time, it acquired a AAA balance sheet over all those years. Only Microsoft is the other company in the world with such a strong balance sheet. And such a balance sheet matters because it keeps capital cheap for a company like Johnson & Johnson. But it was really having this AAA balance sheet also because it was such a well-diverse business. And now they are going to split up. So let's see what this all has to do here. And let's start looking into actually what the spin-off is all about. So what Johnson & Johnson is doing, it's creating two independent companies going forward. The pharma and the medical device business on the left hand, with the Stelara brand as an example as a drug, they will continue to be the new Johnson & Johnson. So the legacy business will be transformed into this new pharma and medical devices business. And what they will spin off is the consumer business. And we know this consumer business from, for instance, Listerine or Band-Aid or some of the other products here like Nicorette if you want to stop smoking. What's good to know, the new business going forward will be approximately 77 billion in revenue generating it, and the consumer health company, they don't have a working name for it yet, will be approximately 15 billion in revenue. This means on just the revenue basis, let's say 16.3% of sales is going to be spun off from the traditional Johnson & Johnson. If we then look into the new pharmaceutical and medical device company, what is good to know is that 65% is pharmacy and 35% is medical devices. The biggest revenue drivers here in the pharma business are drugs around immunology and oncology. Medical devices, the biggest one is in orthopedics, but also surgery and vision are quite some business units that are contributing to this. So how do they look at pharma? It's typical as most pharma companies nowadays. It's all about data science. They want to leverage all the opportunities they see in using, for instance, real-world data they collect in collaboration with hospitals, patients, clinical trials to give better solutions to patients. And this is really what they call also the patient journey. They believe that using the equipment that they have, let's say from the medical devices, together with the drugs will allow a total package to a patient so that they better recover and quicker recover. That's kind of the whole idea about this pharma and medical business. If we then look at the new consumer health company, this is also a big business again, and it has essential health, specialty 33%, over the counter 35%, and skin health and beauty around 32%. It's a 15 billion business, so let's say about 5 billion each in sales. We do know that it has a lot of big brands here, so it will not be like a company that's being spun off without anything in it. It has really some market-leading brands in the world, which really will require them to compete with Procter & Gamble and Unilever and the likes. So you might wonder then, why are they spinning this off? So besides the announcement, there was also a webcast, and this is what I took from the script of the webcast. And there's one analyst that was exactly asking this: why now? Because wasn't this diversified business model really good, for instance, to offset downturns? And we've seen that last year during the pandemic, right? And why not split it in three then? Because there are many companies that say something about medical devices combined with pharma, but this has yet to show value, according to this analyst. So here comes the bullshit a little bit from the CEO, Alex Gorski, who says like, well, diversified portfolio is rooted in strategy. However, it's not anchored in strategy. But what I'm really reading here is like, this is the end of the conglomerates like General Electric and other companies as how we know them from the last 20 years or 30 years. This kind of business is over, and we will see more and more specialized businesses, because I honestly think that there's little synergy as what the CEOs come to recognize at this moment in time. That's just why they are splitting it up, but they're still, convinced that medical and pharma will stick together and that is of value to the patient and to the business overall in the long run. But they see that the consumer business has no synergy anymore. And that's something also they say that they learned during the depth of the pandemic last year. So it's a little bit of bullshit. You can make an argument for both merging them. You can make an argument for both splitting them up. I think it's just the wave of our times that we're living in right now in the investment community. But hey, knowing this, actually, there's one thing that I also want to clarify, and that's about the talc liability. Because this is not clear for everyone, I noticed on social media and in the investment community. But listen up, this has already been taken care of. So the liability of the talc powder litigation is neither part of pharma, neither part of the consumer health business, because they already created a different entity for that, and that's already covered. That was an announcement a few weeks ago. So you could even argue, well, there are three businesses. There's pharma, there's consumer health, and there are the talc litigation cases, which they are declaring bankrupt at this moment in time. Okay, so let's look a little bit into the consumer business now. I will do that also by comparing it to the future competitors of it. So if we look at the consumer business, I would say that there is again a lot of stuff in here, which is, Alex Gorski is probably really happy with this and wants to, make it nicer than it is. He thinks that the business is positioned and performing really well, and, that it should at least allow them to have accelerated growth and reach even more consumers around the world. Well, accelerated growth is needed because the company is really not growing that much. Look at this. Over the last 5 years in revenue, 1.1%, even compared to last year. There's limited growth, 4% or something like that. And you need to know, last year was a pandemic, and some of these products should have done really well during a pandemic. If we then look at where it comes from, so over-the-counter was really performing well with 8.5% growth, but the skin health beauty was down, baby care is down, also women's health is down, but wound care is a bit up again. So overall 1.1%. So yes, there's a lot of room for accelerated growth going forward, of course. If we then also look at the margin, the operating margin, and this is important because this is also how we look at such companies in the consumer space. So it has been hovering around, let's say, 16%. The 2020 is negative because of the talc powder litigation and the one-off they took this year. But overall, what is also good to know is that at this moment in time, Johnson & Johnson is trading at a price to sales for 5.2 based on 2020 numbers. And this is what I would like to keep tracking forward when we look into some of the competition. So from that point of view, this is just a poor performing business that they are spinning off. But if we then look at Unilever, for instance, their beauty and healthcare business, it's generating 16.1 billion over the first 9 months. Remember, Johnson & Johnson earned 14 billion in sales over the full year of 2020. So just Unilever alone is already, let's say, a third bigger than Johnson & Johnson overall if we would look at the full year numbers. And their operating margin from Unilever is a little bit more than Johnson & Johnson. Now, when you think about this, Unilever is really being punished all the time in the media for its poor performance, its poor operating margins and such. Well, Johnson & Johnson is doing worse, so I expect the multiple not to be too high for Johnson & Johnson as what the investment market will reward them with. So just keep this in mind, because Johnson & Johnson is always considered a really powerhouse, also with the consumer business. It's really not a well-performing business in my opinion. If we then look at Procter & Gamble, this is really a high-performing business here. You can see that just Procter & Gamble already made 76 billion last year compared to the 14 billion. But of course, there's the healthcare in it where we can compare it more with Johnson & Johnson, probably also some of the baby, feminine and family care business. All this together would be 27 billion. So if you compare it like that, it's probably twice the size of Johnson & Johnson consumer business. Also here, if you look at it, the operating margin is 23% on average for a company like Procter & Gamble. This is really where the comparison can be seen with Johnson & Johnson, because Johnson & Johnson has a lot of room for operational performance and acceleration of growth here. So imagine that their profit margin or operating margin would go from 16 to 23%. It would be almost a 50% increase in earnings for a company like Johnson & Johnson. I think this is the benchmark when we talk about accelerated growth that Johnson & Johnson should look at in achieving. And Unilever as well, by the way. So from that point of view, I think it has a lot of room to grow when there's really a CEO that understands this and works on the operating margin going forward and operational excellence. In that case, this consumer business could actually become a really interesting part of the company and part of our investments going forward. So what about the pharma business then? Let's have a look into that as well. So the pharma business, we saw that already, is around 77 billion. 2/3 goes to pharma, 1/3 to medical devices. But what is important, if we look at the first 9 months, 17 billion out of the 38 billion, so 45% just comes from 4 drugs that are actually fast growing. So there's a lot of, I would say, tailwinds for this company at the moment, and it's really the faster part of the business currently in Johnson & Johnson. It's also actually the reason why Johnson & Johnson was still growing with 7% overall over the last years. It's really because of the pharma business. For me, this is a golden asset. And just look at Stelara, 6.8 billion in sales from a 5.5 basis last year. This is really a big selling drugs, and you don't see these kinds of sales in other companies too often, just so you know. So 45% coming from 4 fast-growing drugs. You need to take this into account. Also, some drugs are going off patent, so you get the risk associated to a pure biotech company. And let's also call the biotech, not anymore a traditional pharma, because it is biotech. If we look at it here, you can also see from the pharma and medical devices going forward, pharma had a compound annual growth rate of 6.3%, but you see that medical devices was really going nowhere. There's not too much different than a company like Roche, as an example. We'll see that soon. But look at Johnson & Johnson here. The pharma business is spotting around 30% margin, operating margin on the business. So it's not only the fastest growing, it is also the most profitable business in their company. Johnson & Johnson, on the other hand, when we look at the medical devices, is, I guess, around 17, 18, 20% margin, not really growing. So for me, I'm not really convinced yet that these two companies should be together in one. And yes, the analyst is right here. Why not split it off in 3 if you're anyway splitting it off and keeping just the pharma? I would say it still gives at least a little bit of stability in case the pharma business would not perform that strong. But from the other side, you can also consider this a stone around the neck. Future will tell us. If you then look at Roche, just in comparison, J&J 45 billion when it comes to pharma and medical devices. Why Roche actually? Because Roche has a pharma and a dia business. It's really comparable to the new Johnson & Johnson that they have been creating. At least Johnson & Johnson will be similar to Roche from that point of view, because it is 45 billion in sales in pharma as well. Actually, the diagnostics here was having around 14 billion. And as we just saw, Johnson & Johnson business in medical devices is twice as big almost. So from that point of view, Johnson & Johnson will still stay the biggest biopharma company in the world, with Roche as a second player after it. If we look at the sales margin here, the operating sales, you can see here that the Roche is actually getting better operating margin on their drugs than Johnson & Johnson. And from a diagnostics point of view, we can see that again, the medical device industry from Johnson & Johnson, or the business, is just doing better. Overall, I would say Roche has a better operating margin. So here again, Johnson & Johnson has room to improve themselves so that they become a true competitor and a top A player, also from operational excellence point of view going forward. If we look at Pfizer then, which we can better compare purely with the pharma business, we can here see as well that Johnson & Johnson has similar sales, a little bit more than Pfizer, and Pfizer has here operating margin of around 25 to 29. So from this point of view, Johnson & Johnson is a better business than Pfizer, also when we look at their profitability. Last but not least, we can also compare the medical device business then to the Medtronic business. And here we can see that the sales for Johnson & Johnson was 25 billion with a margin of 20% versus a 30 billion and a margin of 25%. Again, this tells us that Johnson & Johnson again can become more operational, effective and stronger performing based on, let's say, peering themselves up to Medtronic. So what this tells me that both the consumer business and the pharma and the medical devices business are not really performing so well compared to their peers. There's still a lot of, I think, cost savings to be made, profit to be increased based on the current business. And this is actually good, because if we really take the narrative from splitting up these companies into 2 or 3, because then there will be more focus and more, more focus also on the cost part of the company. I think this is where the opportunity is for Johnson & Johnson when comparing it to their peers. So far so good. But then the question remains now is like, will we get shares actually? Because this is a little bit fake to most of us as dividend investors, because we're not really used to the accounting language. Now, what does the company say itself? They tell us that we get tax-free separation for US federal income tax purposes. Beats me what that is, right? At the same time, they also mention something about the dividend, that it should stay at least on the same level as what the combined company offers us now. So I went back to the Q&A session of the webcast, and here they say, our intent is to effect the separation through the capital markets. And this is for me actually quite clear then. This means a share spin-off. So we should get some shares from the new company, the consumer health business, going forward. They say that it will take 18 to 24 months before this is to effectuate. So I believe that this will be, let's say, somewhere in the summer of 23 going to happen. And I will show you later also how many shares I think we'll be getting. I'm 95% sure based on this wording, not 100% sure. So I might still be wrong. Just keep that in mind. So what about then the dividends and the dividend aristocrat status? I think this is also a question that many people in the community have in their head. Well, what's probably good to know here is again that they believe that the dividend is in general safe going forward, and they want to keep it at the same level as I just mentioned. So from that point of view, the CEO is, this is actually not the CEO, but Joseph is quite convinced here. But we have a good reference here when it comes to then also to the dividend king status or dividend aristocrat status, because here I show you the dividend history of Abbott after it spun off AbbVie. So it had a 51 cents in 2012 in dividends, and I think it was a quarterly dividend, yeah. And then after the spin-off, it became 14 cents per share. What happened when you go to dripinvesting.org, you can also see here that that accounts have been reset. So the 59 years of Johnson & Johnson will probably technically be lost going forward, and we'll have to put the counter again from 0, from number 1. So you will probably see it dropping off a lot of list of dividend aristocrats, but don't be fooled by that, because people looking at it, let's say 10 years from now, they will think like, oh, it only has 7 or 8 years dividend growth. No, we just put it on top of the 59 as long as the company after the split off would of course continue to grow their dividends. And I have no reason why. Remember, they have a AAA balance sheet. Speaking of which, they feel that they will continue to have AAA balance sheets for both of these. They said they had a very good dialogue with both the rating agencies, but I saw somewhere already on the net about Moody's saying like, well, the consumer health business is at risk of losing their AAA rating status. They gave it a negative credit going forward or something like that, which means in their language, as I understand it, that the AAA rating there will be at risk and might be a AA or whatever they will give it when they reassess it. So I'm not so sure as the CEO itself. Time will tell us. Nevertheless, their balance sheets look rock solid. So from that point of view, I feel like the dividend is really safe and continues to be one of the safest in the community. So the question then is like, will I keep the stocks? What will I do with my shares? Well, of course, it's a bit too early to tell right now, but I did some math here and what I wanted to show with you. And I like doing these kinds of things because it, can tell us a little bit like, will I be right in let's say, once this is all announced? So look at it. Johnson & Johnson has a total market cap of 435 billion right now. I gave the consumer health business a sales multiple of 3. This would give it around a valuation of 45 billion. Why sales multiple of 3? it's kind of in between Procter & Gamble and Unilever, while knowing that it's still having lower operating margins than Unilever at this moment in time. So what remains is 390 billion, which will give for the pharma and medical devices business, which gives it a sales multiple of 5.6. Based on the sales of 69 billion, we can say here that the consumer health business, in my opinion, is worth around 11% of the current stock. The share price is $165 at the moment, so let's say $17 will probably remain and go with the consumer health business. The other, $148 of share price will probably stay with the new Johnson & Johnson. So from that point of view, I think if the new Johnson & Johnson would just hike the dividend with 12-13%, and even on the new Johnson & Johnson, there will be a continuation of the dividend king status. Who knows? It might be possible, but this is probably good to know. 11% consumer health, 89% pharma and devices. Knowing this, I will probably not sell it based on this. Because, 11% will be relatively small business, but, it's a consumer health, it's stable. I like consumer staples as well. So based on the information today, I will probably not sell it. But just know my fair value, and this was based on the video from 3 weeks ago. So if you want to learn more about that, go to that video. I'll put in the link of the description. Is around $144. And of course, it's now $20 overpriced for me. So I'm not adding more. Based on how the spin-off works and based on whether there comes a dip, I will just continue to investing because I have no reason to believe that anything significantly will change going forward. And like I just mentioned, it's a good business and actually with a lot of room to grow if they get the cost under control. Last but not least, what's next? We will hear more probably next week or this week actually on 18 November. I will be listening in to the pharmaceutical business review because that's where they will answer more questions and hopefully we'll get a little bit more clarity about the stock split, what it really means and whether it's indeed 11 versus 89%. So remind this, 11% consumer health, 89% for the pharma, and we'll tune in back on these numbers once the company announced the official numbers. I'm just wondering how much I will be off and whether my calculation made sense. Having said that, this was all I could show you today about the spin-off from Johnson & Johnson into two business segments. I hope you enjoyed this. I think I answered quite some questions that typical dividend growth investors have in their mind. So if you like this, don't forget to like and subscribe this video. It means the world to me. You put a smile on my face. And for the rest, have a great week.